Money management. Introduction to the module. International economic and monetary developments are responsible for multi-year currency trends. But, between this week and next, those forces are far less reliable. Between today and tomorrow, they hardly matter at all. Over the next hour, anything can happen. Successful trading, therefore, requires not just careful analysis, but also the smart management of your precious capital. You must always have a plan for when things go well, but also for when they go wrong. This module will introduce you to the essential concept of money management. Risk and reward. The ratio of reward to risk is one of two key measures in money management. Reward is to the profit the trader is expecting to make. Risk is to the loss a trader is willing to incur in the pursuit of that reward. We can refer to this ratio to describe a prospective trading position. For example, the trader is willing to accept a 100 pip loss in the hope of making a 200 pip gain. The reward-risk ratio, in this case, is 2:1. Similarly, we use the ratio to describe a historical average of past trading performance. A trader who, on average, realizes a gain of 70 pips on winning trading positions, but loses 50 pips on losing ones, has a historical ratio of 7:5. It appears counterintuitive, but a high reward-risk ratio is not essential for success in the forex markets. One must also consider how often those trading positions are correct. The measure of the number of winners to the number of losers is called the win-loss ratio. Irrespective of the trading strategy, these two ratios are inescapable. Consider the performance of two traders, A and B. Trader A has an unimpressive average reward-risk ratio of 1:1, but, thanks to a win-loss ratio of 10:1, is still hugely profitable. Trader B has an impressive reward-risk ratio of 4:1, but, because of a woeful win-loss ratio of 1:5, accumulates only losses. Even the best traders are often right less than half of the time. The win-loss ratio is also not entirely under traders' control. It is vital to know it, but they might not be able to do anything to improve it. In contrast, the trader has the power to set the reward-risk ratio. Balancing risk and reward, therefore, is the primary lever of money management. Entry. Assume that, on average, only a third of your trading positions are successful. A win-loss ratio of just 1:2 seems modest, but many seasoned traders are unable to achieve better. With such a ratio, though, your average winner must be twice the size of your average loser just to break even. It is this reward-risk ratio of 2:1 that must determine the entry price of your trading position. Imagine the euros by United States dollars has been oscillating recently between 1.3510 and 1.3650. You believe this price action will continue. The euro is nearing the lower border of the price range again, and you consider buying, going long, for the next upswing, but at what entry price? Given the minimum reward-risk ratio of 2:1, the entry price must be in the lower third of that range, in other words, below 1.3556. However, this is only sufficient to break even. To secure sustainable trading profits, and considering spreads and other transaction costs, a ratio of 3:1 or more might be necessary. You decide on an entry price of 1.3538, 4:1. You must never enter at a price higher than this. It is remarkably easy for traders to convince themselves that maybe this time, the price will not fall back right to the lower end of the range. Or, perhaps this time, it will rise beyond the upper border. They do this to justify a higher entry price than their risk management rule demands. They just want to be active. Doing nothing, however, is sometimes the best decision a trader can make. Exit. Traders can enter any number of trading positions, but they can only exit the ones they hold. In principle, therefore, exiting should be more straightforward. And it is, as long as they do so at either the upper or lower boundary previously identified. Yet, waiting for the market price to reach a profit objective can be frustrating. Impatience causes many traders to exit winning positions early. While they may be satisfied with the immediate profit, the diminished reward-risk ratio might erase any chance of sustainable success. Similarly, because realizing losses is deeply unsatisfying, traders sometimes hesitate before exiting losing positions. Incurring more substantial losses than planned also diminishes the reward-risk ratio and compromises long-term profitability. Stops. The former heavyweight boxing champion, Mike Tyson, famously said, "Is to everybody has a plan until they get punched in the mouth." Whatever your trading strategy, something can always go wrong. To prepare for the metaphorical punch in the mouth, smart traders set stops. A stop is an order given to the service provider or broker to exit a position under specific conditions. The list of possible exit conditions is endless as to. At the close of business on Friday, ahead of the release of economic data, if a market indicator flashes red, if there is an adverse price move signaled by the attainment of a specific price. The last of these is, by far, the more common. You must set stops as soon as you enter a new position. Capital allocation. The concept of average win-loss ratio, or average reward-risk ratio, assumes there are sufficient trades to average. So, subdivide your capital into as many equal portions as is possible for trading non-negligible position sizes, at least 30 or 40 portions. Treat each portion as the money amount that might be lost if the position is unsuccessful. You should then trade the position size that corresponds to the potential loss in pips. For example, a nearby stop would permit a larger position size for the same risk capital. A distant stop would require a smaller position size. This approach will give you many chances to test your strategy.